At a special town meeting on September 16th, Madison voters will discuss changes to the town tax rate. Recently, a substantial decrease in the valuation at UPM Madison, or Madison paper, has resulted in an increase to local taxes. The tax rate has not yet been set in Madison, but unless action is taken, residents could see the tax rate increase from 17.5% to nearly 23%. The tax rate depends on two things: the amount of money all the property in town is worth and how much money is needed to operate the town. In 2013, the town valuation was approximately $485 million. The amount needed to operate the town and the school came to about $8.5 million. That resulted in a tax rate of 17.53. In other words, if you own property worth $100,000, your annual taxes are $1,753. Now let's take a look at the current year. In June, residents approved a lower budget, meaning the amount needed went down from $8.5 to $7.9 million. With the change to Madison paper, the total town valuation also went down to $345 million, resulting in the higher tax rate and potentially higher tax payment. So how did we get here? Many different entities are involved in this process. There's not one person who controls all the parts. The amount needed to fund the budget comes from work of the Board of Selectmen, the Advisory Board, the town manager. The school board works to put its budget together, and finally, the town votes to accept it. The other side of the equation is under the guidance of the Board of Assessors. They meet to determine the valuation of the town and to set the local tax rate. Obviously, residents are troubled by the sudden drop in valuation at the mill, and some have asked about getting a second opinion. Residents can vote to allocate money for an outside appraisal of Madison paper, but at this point, it would not change the valuation for this tax year, and therefore wouldn't change the current situation. The mill valuation of $80 million is set for this year. Can the town look to the state for some relief? The most significant relief will come when the state recognizes Madison's lower valuation and provides more funding for education. When school funding goes up, the local budget would go down, resulting in some tax relief. But unfortunately, the state does not recognize changes to valuation right away, so this relief would not come for another 2 to 3 years. What can we do right now? Well, if no action is taken, the tax rate will be set at 23%. At town meeting, residents will be asked to approve a 3-part plan to keep the tax rate under 20%. Under Article 2, voters will decide whether or not to authorize the town to establish a line of credit of up to $2.5 million. This will allow the town to make up for the money not collected at the higher tax rate. The Board of Selectmen would have the authority to borrow money as needed and pay it back to get by until the state valuation catches up. $2.5 million is a lot of money to borrow, so the plan also includes using money from savings to fund the budget and keep the tax rate under 20%. The town's savings account, otherwise known as undesignated fund balance, has approximately $1.5 million. Under Article 3, residents are to decide to see if the town would take $800,000 from savings to help keep the tax rate under 20%. This action would leave a balance of approximately $700,000 in savings. There is a third part of the plan that involves spending money from the town's TIF fund. Article 4 allows voters to decide whether or not to take up to $500,000 in tax incremental financing district funds to be applied to the general fund to reduce taxes. Utilizing TIF money in this manner is more complicated than simply using money out of savings and requires a bit more explanation. In 2006, the town of Madison entered into a TIF agreement with Backyard Farms that will mature in 2035. Under the agreement, Backyard Farms has a more complicated way of paying taxes. Currently, the value of backyard farms is approximately $50 million. Of that, $18 million is exempt from taxation through the state's Business Equipment Tax Exemption Program, otherwise known as BETE. We'll talk more about BETE in just a moment. Subtracting the $18 million from $50 million leaves a taxable value of $31.6 million. At last year's tax rate of $17.53, Backyard Farms paid $554,000 in property taxes. Under the TIF agreement, as soon as that money comes in, the town turns around and writes Backyard Farms a check for $388,000, or 70% of their taxes, for Backyard Farms to use on business development. The remaining 30%, or $166,000, the town keeps to be used on approved economic development projects. In 2013, Madison updated its project list to include business development projects, road improvements, and portions of the highway, fire, and administrative budget lines. These projects were approved both by Madison voters and by the State Office of Economic and Community Development. Under the TIF agreement, the town not only receives $166,000, but is able to apply to the state for a 100% reimbursement of the taxes that are exempt under the state BETE program. By applying last year's tax rate of $17.53 to the $18 million worth of tax-exempt equipment, you end up with around $325,000 that the town is eligible to receive as a reimbursement from the state, again to be used for economic development projects. Last year, the town received a total of $491,000 in TIF revenues. However, to use TIF funds to reduce taxes is not an approved use, and the state has put regulations in place to discourage towns from moving money out of their TIF accounts into the general fund. The result of moving $500,000 from TIF could cost the town up to $380,000 in lost revenue and increased taxes over the next 3 to 4 years. This happens in two ways. First, the town would lose its advantage of applying for the 100% BETE reimbursement, dropping it down to 70%, which means instead of receiving $325,000, the town could only apply for $227,000, resulting in a net loss of $97,000. And this loss would come immediately. The second wave of penalties would come in 2016. When the state looks at Madison's valuation, it will see that $500,000 was moved from TIF, which would equate to an increase in the town's value of approximately $25 million for 1 year. That would increase county taxes by $55,000, reduce education funding by over $200,000, and reduce revenue sharing by approximately $16,000, resulting in a loss of $284,000 to the town. Town officials have asked local legislators to help by seeking to have the state waive the penalties, but no action would be taken until the legislature begins its new session in January. Under the current state tax law, moving $500,000 out of TIF could cost the town upwards of $381,000.